Hey everybody, it's Daniel here from Infovest. Hope you're all doing well. Today I want to talk about Kashkari. Kashkari came out yesterday, and for those who don't know, Kashkari is one of the Fed members in the FOMC committee, and he came out and basically said the following. If no progress on inflation, I don't see why rates couldn't go above 4.5%. I could see easily rates getting to mid 4% next year. If I don't see progress on inflation, I don't see why rates could not even go higher. The risk to the markets next year is that if we don't see progress on inflation by around March, then the Fed will have to signal another round of hiking that will send the US dollar into orbit and cut down risk assets again. Fed Kashkari also came out and said that he doesn't see core inflation has come down and hasn't seen it peaked yet, and that's a big problem for him. Now here's the big thing: what I just mentioned here. The fact that Kashkari came out and said that he doesn't see why rates couldn't go above 4.5%, especially if inflation is still at elevated levels, especially if there's no progress on it, which basically means that you could see 5% plus next year. Now, what's very interesting is the dot plot in the last FOMC meeting. The dot plot suggested that rates would be around, let's say, 4.5 to, let's say, maximum 4.75%. And the fact that majority of those dots are close but right under 5%, to me, how I read that, and after also reading this, to me it's a signal that the Fed members are not calling 5% because maybe they don't want to shock the markets too much, but they have in the back of their mind that they could easily get there for next year. And I wouldn't be surprised. I honestly wouldn't be surprised to see interest rates above 5% next year in the US, especially if nothing breaks by then, right? If still things are going okay and if inflation's still elevated and there's no progress on it, definitely I wouldn't see I wouldn't see any reason why rates wouldn't hit 5%. A lot of people think that, once we get to 4.5, 4.75, then boom, it's done, right? We're not hiking anymore. I'm actually on the camp that believes that, we could see 5% or higher next year, as long as nothing truly collapses or breaks. If we're still good heading into next year, nothing's really collapsing, and even if there is a little bit signs that inflation is somewhat coming off a little bit, then I'm still on that camp that we could see 5% plus in interest rates. Of course, I could be wrong, but that's my take after seeing the last dot plot because of how close they were to 5%, and after reading and hearing this hawkish comment from Kashkari. So 5% plus, what would that look like? How would that play in the markets, right? And maybe this is what the Fed really wants, is again to create a demand crush, to crush demand, to create a massive recession, to create a plunge in the stock market, because the terminal rate in for the Federal Reserve, the terminal rate is way below the inflation level. And in history, if you look at how inflation was tackled, generally rates went above the inflation rate. So either two things has to happen. Either inflation comes below that terminal rate, or you increase that terminal rate, you increase the rate above inflation, which would be complete disaster, especially where the economy is, especially how so many countries out there have a high debt to GDP ratio, have a high debt level. Imagine you owe money and rates are increasing, and you're at high levels of debt, you will end up paying more because of those interest rates. So especially with the a lot of governments out there are facing the pinch, facing the pain, because one, debt levels are high, two, rates are moving up, three, the dollar's going up, and other country currencies, their currencies are moving against the dollar, going down. And you have to pay your debts, you have to pay bills, you have to do trade in US dollar, and you have debt that is also in US dollar for many of these countries. It's going to bring a lot of pain for a lot of people, and especially the pension funds, which is, quite of an eye opener, to see that pension funds, which you and I would look at as, funds that wouldn't act like a hedge fund, funds that wouldn't take much risk, right? Funds that would safeguard your money. Pension funds going and leveraging, and now in the UK getting margin called, like holy cow, right? I mean, and I understand because, we had rates low for a very long time, and we're at unprecedented times, and with this COVID scenario and supply chain disruptions and huge changes in terms of globalization and how trade is going to look like down the road, right? We have pretty high inflation, and you got to fight it. The central banks are going to do what they have to do to fight it, to bring to raise the interest rates, to bring inflation down. And as you increase rates higher and higher, you're going to pinch the consumer harder. You're going to twist the arm of the consumer, and not only consumers, the corporations as well, the pension funds, the financial system, the loans, the banking system, the treasuries, the debt that you have there. It's going to be a disaster if this continues to go. So, and when I look at the inflation story, when I look at what's happening from a supply chain side, when I look at the news flow coming out from China, especially with their zero COVID policy, and the fact that they are shutting down certain cities where millions of people are, and that definitely disrupts the supply chain. The fact that there's tensions between U.S. and China, and the chip shortages and etc. That definitely brings inflation, continues to bring inflation elevated, and especially if we're going to now have to adopt to new regimes and new style, and there's going to be structural change in the economy, from trade to let's say food and supply, and the power shift between the West and the East, and inflation continues to be elevated, and energy prices continue to be elevated, and the war continues to go on. I mean, sure, 5% plus, next year, I see that's definitely a possibility. I'm actually more surprised that the last dot plot we got, I'm surprised that the dots didn't even touch 5% and above. I'm surprised that they were below, the 5% level. Actually, I'm not so surprised, because that's how the Fed wants to play things in a gentle way. They don't want to cause panic. So I understand that from that point of view. But looking at that just tells me that, hey, the bar is right here. You've got your dot projections right below the 5% bar. Just call it 5%. Why are we calling it 4.5, 4.75%? We're just sounding, less hawkish. But I think, and that is the reason why. One is the dot plot, one is this Kashkari comment that just basically confirms a little bit more of my view, that I think that we could see easily 5% plus in interest rates, which will definitely put downward pressure on equities, which will definitely put pressure on the system and the businesses out there. Definitely crashes, definitely looming. And you will see other financial products like bonds continue to sell off, which they are today. Gold selling off, all currencies selling off, the dollar going into orbit, right? And oil is a little different story, but definitely you could see some sell-offs in oil as well on recession fears. Now, let's see what happens. We'll have to reassess. We'll have to see how this inflation story pans out. But it just doesn't look so pretty. It doesn't look so pretty from this point on. And another thing I want you to take a look at if you get time is take a look at the yield curve. The 10 to 2 year spread, the US yield curve, it's still in inverted territory. We haven't steepened yet. Bonds haven't rallied yet. Bonds are still selling off. The yield curve is still inverted. And just yesterday, the 10 year against the 10 year to 3 month spread just inverted yesterday. Which again tells you from the bond market, where a lot of smart money traders like to trade, a lot of these institutions like to trade, it's signaling to you that rates can continue to be elevated for some time and can continue to rise, because we haven't had that steepening moment. What I'm waiting for is that steepening moment to now see that, okay, the expectations of higher rates are probably going to subside, and we're going to see probably the pivot that everyone's looking for, the rate cuts that everyone's looking for. But I don't think anytime soon. And it's quite funny that we were talking about pivot. The markets were talking about pivot last month and the month before, and saying that the Fed is going to change and we're going to stop here. We're not going to go higher. But history has showed us that, to get inflation down, we need to get the terminal rate above the inflation. But right now, we're not there. And what would that mean? We have to bring the terminal rate to 8%, 9%. That's just going to kill the economy completely. So something's got to happen. Something's going to break. And again, like I've been saying in all my videos, and I don't mean to sound like a fear-mongering channel or anything like that, but I'm giving you the facts as it is, and these are just my opinions. This is not financial advice or anything like that. These are my opinions from looking at how the monetary policy and the fiscal policies out there, and all the products out there, how they're playing out, and the comments that are coming out from the FOMC members. It's just giving more fuel to the fire that something is not right. Anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, hit the bell icon for more, and for if you want more videos, get notified on the next videos. And let me know what you guys think about interest rates in the US. Do you think we're going to hit 5% or higher? Do you think it's a one and done kind of thing once we finish in December? Let me know. Leave your comment below. All right, thanks. Bye.